Foreign currency can be a travel tool, a business necessity, or a directional bet. The dangerous mistake is treating all three as the same decision. If you need euros for a hotel next month, the question is how to obtain and use them safely. If you buy euros because you expect the dollar to fall, the question is whether you can bear being wrong. Stay with that split, because the word Forex can make ordinary exchange sound like investing and speculative trading sound like routine banking. In a moment, we'll separate the rate you see from the rate you actually receive. First, name the transaction you're trying to complete.
A currency exchange is a relative price. One unit of one currency is priced in another currency. That's why a statement like "the euro is up" is incomplete until we ask, up against what, over which period, and for whom? The International Monetary Fund defines an exchange rate as the price of one currency in terms of another. That definition is plain, but it prevents a great deal of loose thinking.
We've run this experiment before. Call a moving price a certainty, then act surprised when it moves again.
Lewis, give us the practical fork. A family has a trip in 6 weeks. A viewer also sees a video predicting a stronger euro. Same currency, different decision.
Different clocks, different jobs. The family has a known expense and a date. The viewer has a forecast and an uncertain exit. One may compare payment methods and exchange costs. The other is accepting a price risk for a hoped-for gain. Don't borrow the language of necessity to make a gamble sound pre-approved.
That's step 1 of the investment map. Name the goal. Here it means writing one sentence before looking at a chart. I need this currency to pay or receive a stated amount by this date, or I'm considering a speculative position whose value can fall. The sentence doesn't decide for you. It stops two unlike decisions from sharing one excuse.
There are also middle cases. A freelancer paid in another currency, a student paying an overseas bill, or a company buying inventory may have real exchange exposure without becoming a Forex trader. The useful question isn't whether foreign currency is sophisticated. It's whether a change in the rate could disrupt a payment, margin, budget, or cash flow plan.
And a chart doesn't know your invoice date. It's remarkably indifferent that way.
For the working level viewer, separate 3 exposures. Transaction exposure is a payment or receipt denominated in another currency. Translation exposure is how foreign currency balances appear when converted into reporting currency. Speculative exposure is taking a position because you expect a relative price to change. The accounting and tax treatment can be personal and fact-dependent. That's a qualified tax professional's lane, not a public video's conclusion.
That boundary matters. We can teach the mechanism, ask better questions, and show records to collect. Your bank can explain its exchange services and account terms. A broker can explain a trading product and its risk disclosures. A qualified tax professional can address facts of your own return. Nobody watching a general lesson should pretend those answers arrive from a currency headline. One more distinction helps when people say they're holding foreign currency: cash in a travel wallet, a bank balance, a fund with overseas holdings, a currency future, and a leveraged retail position don't give the holder the same rights or risks. The label can hide custody, counterparty, contract, liquidity, and leverage differences. Before comparing outcomes, ask what economic thing you would actually hold or owe. That answer changes which disclosure matters. Before you compare a rate, which sentence describes you? I've a payment with a date, or I'm making a price forecast. Keep that answer visible as we move into cost.
Next, why the exchange rate on a screen can be true and still not be your final cost.
Before we keep going, one small favor that actually moves the needle. If this is landing for you, tap like, then subscribe and turn on the bell so you do not miss the rest. 2 taps, completely free, and it pushes this in front of more people who need it. Professor Duran, when someone says, "I got the exchange rate online," what detail is usually missing?
The executable terms. A reference rate can describe a market relationship, while a bank, card network, exchange counter, remittance service, or broker applies its own timing, spread, fee schedule, and product terms. The useful comparison isn't a headline rate against another headline rate. It's the same currency amount on the same date through the actual method you may use.
A spread is one source of friction. In simplified form, it's the difference between a quoted buy-side and sell-side price. A separate service fee may exist, and timing can matter because a transaction may be priced when it's authorized, processed, or settled under the institution's rules. None of that makes a service improper. It means the total cost needs a complete label.
Nora, a sign that says no fee can be a sentence fragment. The rate may still carry the economics.
Let's do a neutral worksheet, not a recommendation. Imagine you need to pay a stated foreign currency bill. Put the bill amount in one column, then ask each provider for its rate or rate method, every fee, when it locks the price, cancellation terms if relevant, and the amount the recipient receives. Compare the completed rows. That's far more useful than asking which logo has the friendliest ad.
For travel cards, ask the issuer about foreign transaction fees, conversion method, ATM charges, cash advance treatment, and emergency support. The Consumer Financial Protection Bureau explains that an issuer may charge a foreign transaction fee when a purchase is processed outside the United States. That's a prompt to read your account's current disclosures, not a claim that every card charges the same way.
Notice the ownership rule. The CFPB can explain a consumer finance concept. Your card issuer owns the current agreement. Your bank owns its wire, cash, and account terms. A broker owns its foreign exchange product disclosure and margin rules. If a source can't tell you which document controls, it has not finished the job.
What about an airport counter? People here never exchange there as though it were a law. What would you need to see before paying for convenience?
It's not a law. Convenience has a price, and the price should be compared, not assumed. A small emergency amount may solve a real problem. A large, unplanned exchange can deserve more comparison. The honest instruction is confirm the rate and all fees before you hand over funds, then keep the receipt so you can reconcile what happened.
Convenience is allowed. Pretending it's free is the expensive part.
There's a planning habit worth keeping here. For a known payment, decide whether your objective is certainty of amount, convenience, availability, or lowest estimated total cost. Those objectives can conflict. Someone arriving late with no local payment method may rationally value access more than a small rate difference. Someone with time may compare alternatives. The mistake isn't choosing convenience, it's failing to name the trade-off before the transaction makes the choice permanent.
For recurring payments, keep the comparison file rather than relying on one memory of a favorable or unfavorable exchange. Record the date, amount, provider, quoted method, amount delivered, and every charge you can identify. A small log can't predict the next rate. It can reveal which charges are contractual, which vary with the market, and which question should go back to the provider. That's evidence you can use without pretending a past transaction guarantees the next one.
That pays off the promise from the opening. The rate can be real and still not be your cost. The missing add-on is friction, spread, fee, timing, and terms. But a clean travel comparison doesn't answer the much harder question. Should someone take a leveraged currency position because they expect the rate to move? A directional currency trade isn't simply holding foreign cash. It's a claim about a relative price, made under a product's rules, with an entry, exit, financing, margin, and loss path. Those details belong in the first conversation, not after a position is open.
The Commodity Futures Trading Commission is direct about the risk. Its Forex fraud advisory says the market is volatile and carries substantial risks, and warns that margin trading can make a person responsible for losses that greatly exceed the dollar amount deposited. That's not a prediction about any one trade. It's the loss shape a viewer must understand before considering a leveraged product.
Leverage isn't extra insight, it's extra sensitivity.
I want to slow that down. When leverage is involved, a modest market move can have a large effect on the funds committed. Requirements, liquidation practices, financing, and product structure depend on the agreement. That's why I only deposited a small amount isn't a complete risk statement. Erica, what should a viewer read before accepting a pitch?
Read the product disclosure, customer agreement, margin terms if any, execution policy, fee and financing schedule, and the institution's description of what can trigger a closeout or additional obligation. Then write what you don't understand. A broker can explain its own mechanics. It can't turn a public lesson into an individualized suitability determination. Take that broader question to an appropriately qualified financial professional.
People often connect currency forecasts to inflation, interest rates, elections, trade balances, or central bank decisions. Are those useless? No. Are they a trading instruction? Also no. They're inputs in a crowded market where the visible news may already be reflected in prices and where the path can contradict a tidy story.
Erica, Every generation discovers that a plausible explanation isn't the same as a payable trade.
Exactly. Relative inflation or interest rate expectations can affect how market participants think about currencies, but neither relationship supplies a guaranteed direction, timing, or appropriate position size. Treat economic explanations as questions to test against the actual product and your own objective. Don't turn a macro headline into a substitute for risk limits.
The CFTC also gives us a useful fraud screen. It warns about promises of no bear market, claims that you should trade in the interbank market, requests to transfer cash quickly, and difficulty checking a firm's background. That list has a common theme. The pitch asks you to skip ordinary verification because the opportunity supposedly expires before scrutiny arrives.
Pause there. Guaranteed and act now are not market analysis. The CFTC says to check registration status, business background, and disciplinary history. Ask for information in writing, ask for a written risk disclosure, and seek independent licensed advice when appropriate. A person selling a complex trade may be persuasive. The written record is still where the obligation, cost, and risk have to survive.
A working risk note should be concrete enough to be embarrassing if it's ignored. Write the currency pair, the product, why you think you have an edge, what fact would weaken that view, every relevant cost, and the point at which you stop rather than add more money. If that list produces only because rates must change, you have a narrative, not a plan. The note isn't a guarantee. It's a way to expose an unsupported decision before leverage magnifies it. One more working level distinction can keep a currency discussion honest. A person may have a view about an economy and still have no workable trade. A view has to survive the route from idea to instrument. Which account or contract carries the exposure? Is the position spot, a fund holding foreign assets, an option, a future, a forward arrangement, or another product entirely? What currency is the account measured in? What happens if the market moves before an order fills, if liquidity thins, or if the position must be closed at a bad time? Those aren't obscure objections. They're the ordinary places where a broad headline meets a specific agreement. Write them down before you evaluate anyone else's conviction. If a creator can't name the instrument and its loss path, their confidence may be entertainment, but it isn't a complete decision process. Good uncertainty has a name, a source, and a next question. A headline has none of those by itself. Keep the difference visible when a fast market rewards a fast story.
And remember that a currency relationship can appear indirectly. A U.S. investor may hold a foreign company, a global fund, or a business with overseas revenues without opening a retail Forex account. The currency exposure can be one input among business performance, valuation, interest rates, local regulation, taxes, and the fund's own design. That is another reason not to treat buy foreign currency as a universal answer to an inflation or diversification concern. Read the fund or security documents, identify what creates the exposure, and ask the person qualified to discuss your broader plan whether the proposed change actually addresses the goal you named.
That's step 6 of the investment map. Check the source. It means checking the firm and terms before trusting a channel, a referral, or a screenshot. The source check doesn't promise safety. It turns vague confidence into specific records you can compare. Professor Duran, bring the two paths back together. What can a careful viewer do tonight without pretending to predict exchange rates?
Make a one-page currency decision file. At the top, write the purpose, travel payment, foreign invoice, recurring obligation, portfolio exposure, or speculative trade. Next, write the amount, currency pair if relevant, date, institution, and the controlling document. Then list friction and failure, fees, spread, timing, limit, margin, custody, or tax question. The file makes the decision legible before money moves.
One page. If it needs a prophecy, it isn't ready.
And assign each question to its owner. Ask your bank about its transfer, cash, account, and card terms. Ask your card issuer about the agreement that governs a foreign purchase. Ask a broker about its currency product, pricing, margin, custody, and records. Ask a qualified tax professional how facts specific to you may be treated. Ask a qualified financial professional how a decision may fit your objectives and risk capacity. That division prevents one broad question from receiving one dangerously broad answer.
I came in thinking the travel version was simple and the trading version was complicated. That's backwards in one important way. A travel exchange can be simple only after the amount, method, and total cost are written down. The trading version becomes complicated because it adds a forecast, an exit, and sometimes leverage. Same screen, very different burden of proof.
Right. You don't need a grand theory of currencies to compare an upcoming payment. You need the current terms for the method you may use, and you don't need to call a directional trade hedging merely because currency risk exists somewhere in the story. A hedge is tied to a defined exposure and still has costs, basis risk, and implementation choices to understand.
Different jobs, different paperwork.
A final caution: foreign currency can be part of ordinary life, international business, diversified investments, or trading products. The label alone doesn't tell you the appropriate method. Read what you own or owe, what converts it, what it costs, and what can go wrong. If you can't state those 4 items plainly, preserve the uncertainty rather than filling it with a forecast.
There's a useful difference between reducing a known exposure and trying to manufacture a return from an unknown path. A business or household with a payment date may explore methods intended to reduce uncertainty, but the method itself can introduce costs, contract obligations, basis differences, or accounting and tax consequences. That's why a word such as hedge should start a document review, not end one. State the underlying exposure, its amount and date, the instrument or service proposed, what risk remains, and what happens if the exposure changes. The right professional help depends on the real arrangement.
Nora, the forecast is optional, the payment date isn't.
Use the file again when the decision changes. If a trip becomes a longer stay, an invoice is delayed, a provider changes terms, or a speculative idea starts sounding urgent, open the record and rewrite the purpose. The point isn't to make every currency decision slow. It's to make the consequential ones visible before a transfer, trade, or conversion turns a guess into a commitment. Nora's calendar rule applies. The date is part of the product.
That's also the education boundary. We can show a framework, sources, and questions. We can't know your cash needs, other obligations, tax position, account agreement, or capacity for loss from a public screen. Preserve the documents, contact the institution through a source you obtained independently, and bring a focused question to the professional who is qualified to answer it. Specificity is protective. Vague reassurance isn't.
Here is a longer real-world walkthrough. Say you expect to pay a supplier in another currency in 45 days. Start with the invoice amount and due date, not a chart. Ask the bank or payment provider what method it offers, what rate method applies, when that rate becomes final, which fees and spreads may apply, and what the recipient receives. Keep those answers beside the invoice. If the invoice changes, update the file. If the provider's answer points to a contract you haven't read it before the transfer. That's not glamorous, but it turns a vague exchange rate worry into a series of records you can actually check.
Now contrast that with a person considering a currency trade after a video says a central bank decision makes the next move obvious. The person should be able to name the product, the pair, the amount committed, every financing or margin term, the possible loss path, the exit condition, and the evidence that would weaken the thesis. If those answers aren't available, waiting isn't a failure to act. It's a decision to avoid turning uncertainty into leverage. A qualified professional can discuss a person's broader goals and risk capacity. The broker can explain its product mechanics. Neither role is replaced by a general forecast. Add the operational questions that often disappear from a short pitch. How will the order be executed? Who holds the collateral or cash? What happens in a fast market? Can the provider change margin requirements? Which costs accrue while the position remains open? What record will show the trade, conversion, financing, and close? None of those questions predicts a price. They do decide whether a viewer understands the agreement being accepted. If the answer is buried, ask the institution to point to the exact section, save it with the decision file, and return only after the language makes sense.
And don't let a small initial deposit do the talking for you. A small deposit can still sit inside a contract with large sensitivity. Read the obligation, not the advertisement.
Keep this episode for the next time a currency headline tries to turn a payment into a prediction. If it helped, like the lesson and subscribe to Investing Explained. Before you exchange, receive, or trade foreign currency, which missing item will you write down first? Purpose, total cost, controlling terms, or loss path? Keep the purpose clear, keep the records close, and let the decision remain yours. Take care.